In monetary economics, a money multiplier is one of the various closely related ratios of commercial bank money to central bank money under a fractional reserve banking system. Most often, it measures the maximum amount of commercial bank money that can be created by a given unit of central bank money. That is, in a fractional reserve banking system, the total amount of money that the commercial banks are allowed to create is multiple of reserves. The multiple is the reciprocal of reserve ratio and it is known as multiplier. For purposes of monetary policy, what is of most interest is the predicted impact of changes in the central bank money on commercial bank money and in various models of monetary creation. The associate multiple, that is the ratio of these two changes, is called the money multiplier. For example, if one assumes that people hold a constant fraction of deposits as cash, one may add a currency variable, that is currency to deposit ratio, and obtain a multiplier. The proximate determinants of money multiplier are currency to deposit ratio, generally denoted by small c, time deposits to the demand deposit ratio, denoted by small t, and reserve to demand deposit ratio, denoted by small r. In this module, we will study how all these factors determine money multiplier in the economy and also understand the ultimate determinants of these proximate determinants in terms of the scale, interest and structural factors.
After studying this module, we shall be able to know the proximate determinants of the money multiplier, learn about the effects of changes in each of these determinants on the money multiplier, identify the ultimate determinants of the proximate determinants, evaluate the impact of these determinants on the money supply, and analyze the behavior of the proximate and ultimate determinants of the money multiplier in India. The behavioral relation of the money supply equation is M is equal to M CRT into H, where M is equal to ordinary money and H is equal to high-powered money. C is equal to currency deposit ratio, T is term deposit ratio, and R is equal to reserve deposit ratio. Here, the currency oblique demand deposit ratio C, time deposit oblique demand deposit ratio T are representative of the non-bank public's portfolio decisions and are their behavioral ratios, while the reserve ratio R, where R is equal to RR plus E, is largely determined by the central bank through the statutory cash reserve requirement RR and residually by the commercial bank's excess reserve ratio E, where E is equal to ER upon D. Thus, R represents in part the bank's portfolio decision. The money multiplier theory thus decomposes all changes in the money supply M into two broad heads, changes in M and changes in H, but the changes in money multiplier are multi-layered. The equation shows us that the proximate determinants of M and therefore of money supply are further affected by the ultimate determinants like several rates of interest, holdings of black money, spread of banking facilities, etc., which impinge on one or more of the asset ratios. Now, to predict the values of C, T, R, let us look at the empirical analysis of the three ratios. The empirical analysis can be conducted at two levels. A, at the macro level, where it is seen that CTR have been highly stable, implying that changes in CTR have gone in offsetting directions, giving it a long-run stability. Thus, most changes in money supply are attributed to changes in H. B. At an analytical level, the money supply equation can be used to explain the observed behavior and to predict future behavior on the basis of the observed behavior. We can also analyze the variables to be manipulated to bring about changes in money supply. Let us now analyze the effect of changes in CTR on the money multiplier. This can be calculated by differentiating the narrow money multiplier with respect to each of the three ratios CRT, yielding 1. Delta M1 upon delta C is equal to minus 1 minus R1 plus T divided by C plus R into 1 plus T whole square is less than 0 for R1 plus T is less than 1. 2. Delta M1 upon delta C is equal to minus R into 1 plus C by C plus R 1 plus T whole square is less than 0. That is, as T increases, narrow money multiplier decreases and hence narrow money also decreases. However, since M3 is equal to M1 plus TD, an increase in T would imply an increase in M3. Let us now analyze the effect of change in reserve deposit ratio on narrow multiplier. By differentiating the narrow multiplier, we get delta M1 by R equal to minus 1 plus T into 1 plus C by C plus R bracket 1 plus T whole square is less than 0. It can be seen that increases in R T will unambiguously lower the value of M1, while increasing in C will lower M1 so long as R bracket 1 plus T is less than 1, representing the leakage of H into current C holdings or reserves. It is important to note that since the total reserve ratio R is equal to the statutory reserve ratio RR plus the excess reserve ratio E, a change in R could come about through changes in RR or E. It is possible for the impact of changes in RR to be picked up through an adjustment in H or M. If the impact of changes in RR are captured in M, it becomes behaviorally unstable. It may be better, therefore, to capture the changes in the statutory reserve ratio RR by adjusting the high-powered money H star, making it a policy manageable variable, and M star is equal to M upon H star, a behaviorally stable variable. Thus, in the adjusted H approach, the partial derivative of M with respect to R is effectively capturing the effect of changes in the excess reserves on the money multiplier. Let us now calculate the total effect on M of the expected change in each of the ratios C, R, and T. We need to estimate the partial effect of M on each of C, T, and R and add up. Differentiating M is equal to M bracket C, T, R totally, and taking discrete approximations, we get change in M equal to delta M by delta C into change C plus delta M by delta T into change T plus delta M by delta R into change R plus E, with E representing the residual consequent to taking discrete approximations. The three terms on the right-hand side represent the partial contribution to the change in M of the change in each of the ratios C, T, R. The sum of these terms constitute the explained portion of changes in M. We know the values of delta M by C, delta M by delta T, and delta M by delta R, and change in C, change in R, change in T are either observed or predicted. The relative contribution of each of the ratios to the changes in M can be found by dividing both sides of the equation by change in M to yield 1 is equal to delta M by delta C into change in C by change in M plus delta M by delta T into change in T by change in M plus delta M by delta R into change in R by change in M plus E by change in M.
The average broad money multiplier during the 1990s was placed at 3.37 compared with the average narrow money multiplier of the order of 1.15 during the same period. The corresponding incremental money multipliers, that is change in the money stock divided by change in the reserve money, were placed on an average basis at 5.42 and 1.55 for broad money and narrow money respectively. The multipliers M1 and M3 increased during the 1990s vis-a-vis 1980s because of the reduction in cash reserve requirement, that is RR. The average money multiplier was fairly stable in absolute terms with a coefficient of variation of 4.7% for M1 and 10% for M3 during the 1990s, but volatile in incremental terms, 72.9% for M1 and 81.7% for M3. Despite this short-run volatility of incremental multipliers, it is stable in the long run, implying a long-run stable relationship existing between H and M3 with elasticity close to 1.
Of the three proximate determinants of the money multiplier, the ratio C upon DD occupies a pivotal position. The C upon DD ratio conveys the choice of the public between the two components of narrow money, which has important consequences for the money supply analysis. For the higher the C upon DD ratio, the greater the leakage of high-powered money, and therefore the smaller is the secondary expansion of money supply. Both C upon DD and T upon DD thus constitute leakages from the money supply process. Currency demand-deposit ratio could be divided into the scale variable income, the opportunity cost variable rate of interest, and structural variables spread of banking facilities black money. Scale variable income. The growth of income in a growing economy is primarily associated with monetization. Monetization is associated with a variety of changes like spread of banking facilities into unbanked areas, migration from rural to urban areas, changing sectoral composition of the economy, growth in literacy, better transportation and communication network, commercial and industrial development. Income acts as a proxy for most of these developments. However, since both the demand for currency as well as the demand for demand deposits tend to increase with increases in income, a declining C upon DD ratio indicates that the income elasticity of currency demand is less than that of demand deposits. However, since both the demand for currency as well as the demand for demand deposits tend to increase with increases in income, a declining C upon DD ratio indicates that the income elasticity of currency demand is less than that of demand deposits. Structural variables. The spread of banking facilities amongst the population is likely to affect the C upon DD ratio, as it would enable the public to move out of currency into DD deposits and hence could be the cause of a decline in the C upon DD ratio. Another factor which could affect this ratio is black money holdings. In a period of high taxation, people have an incentive to evade taxes and hold them as currency. Apart from the C upon DD ratio, the T upon DD ratio is also affected by the decisions of the public. A rise in the T upon DD ratio would lower the value of the narrow money multiplier and raise that of the broad money multiplier.
The time deposit to demand deposit ratio has increased steadily over the years from 0.53 in 1950-51 to 1.27 in 1970-71 to 3.63 and further to 6.23 in the periods 1980-81 and 2003-4. This reflects the rapid expansion of the banking system and the asset preference of the public. It has been observed that growth in time deposits is more relative to that of demand deposits, and there is a shift in the preference not for illiquidity but for higher returns, longer maturity period deposits. Growing competition from non-bank financial institutions and the inflationary pressures have led to a fall in the real rate of return. Yet the distribution of the deposit increase is in favor of time deposits. We can now look at the key determinants or explanatory variables responsible for the observed behavior of the ratio. The choice of public between these two categories of deposits is governed largely by considerations of liquidity, profitability, that is in terms of higher income earned, and individuals' time preference in portfolio management.
We can now look at the key determinants or explanatory variables responsible for the behavior of the ratio. The choice of the public between the currency demand deposits and time deposit ratio is governed largely by considerations of liquidity, profitability in terms of higher interest income earned, and individual time preference in portfolio management. Scale variable income. Looking at real income as a scale variable, it has been observed that the income elasticity of demand for demand deposits is lower vis-à-vis demand for time deposits. Time deposits are a form of savings and not a medium of exchange. Therefore, as the level of savings increases with a rise in income, people hold more time deposits. Opportunity cost variable interest rate. The choice of the public in favor of time deposits is bound to be governed, however, largely by interest rate considerations. This is so because time deposits as saving instruments have to compete with other financial assets whose rate of return and riskiness becomes important and is hence picked up by the rate of the interest. The interest rates which can be treated as opportunity cost variables are rates of return on post office savings deposits, rates of return on ordinary and preference shares, rates of return on private company deposits of various maturities, along with the rates of interest on small saving schemes. The T upon DD ratio is a decreasing function of these opportunity cost variables. Structural variables. The spread of banking facilities would have no differential impact on the T upon DD ratio as there would be growth in both demand and time deposits. Similarly, increase in tax rates would lead to holdings of black money, which are mostly held as cash, but may even be held in the form of fixed deposits in different banks under the account of different family members to escape detection. The reserve ratio of commercial banks is the one factor which is not directly affected by the behavioral choices of the public. It is an important decision that banks make in determining their portfolio composition in an effort to strike a balance between the considerations of liquidity, profitability, and safety. The basic choice is between cash and non-cash assets or earning assets. The portfolio composition is affected by legal restrictions as well as by institutional changes. For example, nationalization, amalgamation, and liquidation of weak banks, strengthening of paid-up capital requirements of banks, deposit insurance, supervision and inspection of banks by the RBI improve their internal health and strength, while the continuous availability of funds in the call money market and the presence of RBI as a lender of last resort improves the stability of the monetary system and lessens the need of banks to keep cash reserves. The R upon D ratio is composed of two ratios, the RR upon D ratio and the ER upon D ratio. The RR upon D is due to the imposition of the statutory cash reserve requirement imposed by the monetary authorities on the banks to be kept as a proportion of their demand and time liabilities as balances with the RBI. The residual reserves or excess reserve ratio ER upon D are held either as cash in hand or as balances with the RBI. It is these reserves which the banks as a whole use to meet their currency drains as well as clearing drains. These drains on the reserves of the banks arise if there is a big enough shift in the asset preferences of the public from bank deposits to currency or due to drains of cash from one bank to other banks within the system.
Temporary accommodation may be provided, though at a cost in the form of RBI refinancing or through borrowing in the interbank call money market. The excess reserve ratio in India has been steadily decreasing over time. From 2.9% in 1960, it fell to 2.1% in 1975 and just 1.1% in 1986. This was due to the growth of the call money market, which encouraged the banks to lend in and borrow from the call money market and hold excess reserves. Similarly, better utilization of RBI refinance facilities have necessitated a lower holding of excess reserves by banks.
Scale variable total deposits. The scale variable which affects the reserve ratio in the case of banks would be its net demand and time liabilities, which can be represented by the bank's demand and time deposits. Since the reserve ratio is a proportion of these deposits, an increase in these deposits would have a positive impact on the reserve ratio. Opportunity cost variable interest rates. These represent the cost of holding cash by the banks. Since the banks could have made loans and advances, the interest on these is one such opportunity cost. Similarly, the marginal cost of borrowed funds by the banks can be the bank rate, which the banks have to pay to the RBI, or the call money rate, which is the cost of borrowing from or lending in the call money market. Structural variable. Institutional improvements in the banking system reduce the liquidity requirements of banks and strengthen the banking system through weeding out of weak units. Deposit insurance and nationalization have increased the faith in the banking system. An enlarged interbank call money market and easier access to the RBI for loans also obviates the need to keep ER by banks. Let us now analyze the response of money supply to the currency demand, time deposit, and reserve deposit ratios. The money stock is negatively related to the currency deposit ratio because a rise in C upon DD ratio brings about a shift from deposits to currency, and since deposits undergo multiple expansion while currency does not, the net result is contraction of the money multiplier and of the money stock. Initially, reserve ratio on time deposits were lower than those for demand deposits. Then, an increase in TD upon DD ratio raised the availability of free reserves, and the consequent enlargement of the volume of multiple deposit expansion led to monetary expansion. In the case of narrow money multiplier, an increase in TD upon DD ratio leads to monetary contraction when TD upon DD ratio rises the amount of bank reserves required to support time deposits increases. That is, smaller reserves are available to support demand deposits. This implies that the narrow money multiplier falls, leading to narrow money contraction. However, due to increase in the time deposits and increase in the broad money multiplier, there will be an increase in the broad money supply. Enhancement of the reserve ratio or a rise in banks' holding of excess reserves leaves less reserves free to support bank deposits, thereby leading to monetary contraction both in narrow as well as broad money.
In this module, we have learned about the proximate determinants of the narrow and broad money multipliers, the effect of changes in the currency deposit ratio, the time deposit ratio, and the reserve deposit ratio on the money multipliers, the time profile of the average and marginal multipliers showing long run stability, the ultimate determinants of the proximate determinants in terms of the scale, interest, and structural factors. The ultimate determinants of the currency to demand deposit ratio are income, the rate of interest on 1-year fixed deposits, spread of banking facilities, increased tax rates leading to holdings of black money in the form of currency holding. The ultimate determinants of the time deposit to demand deposit ratio are income, rate of interest on the post office deposits, rates of return on ordinary and preference shares, and company deposits of various maturities along with the rate of interest on small savings schemes. The ultimate determinants of the reserve ratio are total liabilities to total deposits of the banks, the rate of interest earned on loans, the bank rate, the call money rate, and the various measures to strengthen the banking system like deposit insurance, nationalization of banks, the enlargement of call money market. A rise in the currency to demand deposit ratio leads to a fall in the narrow and broad money multipliers, and hence a fall in the narrow and broad money multipliers because less reserve are available for secondary deposit creations with increased holding of currency. A rise in the time to demand deposit ratio leads to a fall in the narrow money multiplier, but a rise in the broad money multiplier and a corresponding decrease and increase in the narrow and broad money supply respectively.